Hello, everyone, and welcome to Mawer's 2022 Insight Webcast, where we give clients and listeners the opportunity to ask questions of our portfolio managers, the ones who are pouring through the investment universe day to day, and hear their take on what's going on in the markets. My name is Janelle Hart. I'm an investment counselor at Mawer, and I will be your host today. Before we begin, we would like to acknowledge that even though we are meeting virtually today, we are grateful to host this session in the traditional territories of the Indigenous peoples of the Treaty 7 region and Métis Nation of Alberta, Region 3, and that we have participants in this webcast who are working and living in the traditional land of many other Indigenous peoples. We share the responsibility for stewardship of this land, as well as to its First Peoples, both past and present. Mawer is committed to elevate Indigenous voices and collaborate to advance reconciliation. Now I would like to introduce Paul Moroz, who is Mawer's Chief Investment Officer and the co-manager of Mawer's Global Equity Fund. Paul has prepared a presentation to kick off this webcast, but before he begins, I would like to remind listeners that you can submit additional questions during this session at slido.com, SLIDO.com, using the event code Mawer. Mawer. There was a link in the email you received yesterday to take you to this site as well. We also received a number of questions in advance, which we'll try to cover off first. So we'll see how much we can accomplish within the hour. And without further ado, over to you, Paul.
Okay, thanks, Janelle. I'm going to share my screen now. Let's see if this works. With any luck, you can see the screen and you can hear me.
That's right. You're good to go.
Perfect. Thank you. Okay, this is going to be, well, it could be riveting. Not the disclaimer section. I'm talking about the content of the presentation, which is about math and markets. And I'm going to try to warm you up and keep this to 10 minutes and we'll get into questions. Here's what's going on. Inflation. So the chart you're looking at looks at inflation, US CPI, which is the consumer price index, year-over-year changes over the past 100 years. So inflation, if you've been to the grocery store, it's higher now. I know you know that. In the United States, the most recent CPI print was 8.2%. And we've been through bouts of inflation before, but we just haven't been through this in a while. And you might be asking yourself, well, we've had easy monetary policy or low interest rates for a long period of time. Why did it take this long? Why now? What's the catalyst? It's a really difficult problem to ask because the economy is just so complex. Was it the extra fiscal stimulus during COVID? Was it people dropping out of the labor force? Was it the supply chain challenges that the global economy has? Was it geopolitical tension impacting trade? These are all factors, difficult to say, but we have inflation now. The question becomes, well, how long does it last? And that's another one that we don't know. What we can point out to and observe is some commodity prices are certainly rolling over. So for example, if you look at the price of copper, that's down on a year-over-year basis, 20%. But there's still some pressure on the wage side. I think that you can imagine people might be still asking for raises, or if you recently negotiated a wage, that might be pushing through the system. Now, a consequence of that higher inflation, what's been up is interest rates, and central banks have moved to increase interest rates, and that's led to an increase in bond yields around the world. And the chart you're looking at here is the US 10-year bond yield. It's close to 4%, and this is the highest that it has been in over a decade. Now, why does that matter? And this is where we get into the math. The US bond yield and bond yields in general set the foundation for the required rate of return all around the world. And here's how, if you've thought about financial math before, here's how it works. If you are going to get $1.10 $110 1 year from now, and you want to earn a 10% rate of return, you do the math to figure out how much you pay today for that investment. And that math works out to about $100. Here's what happens. If your required rate of return goes down, that means that the value of the asset goes up. The opposite is also true. As the required rate of return goes up, the value of the asset goes down. And so this is really what's been happening on a larger scale. We just haven't seen this very often in financial markets. The required rate of return, because of inflation and because central banks are raising interest rates, has risen around the world, basically all asset classes. And this is why you've seen both bonds declining in value and equities declining in value, as well as other asset classes. So this is why math hurts. Every cash flow related investment has interest rate sensitivity. The technical term for that is called duration. And what you're looking at on this chart is actually Mawer's a proprietary tool we've built in our database, M42. And it shows the distribution of what we estimate the duration, interest rate sensitivity of our global equity fund. On average, it works out to about 15. So this is just important to understand the math. So what does that mean? It means if the required return around the world for equities goes up 1%, that means for the math to work, for the math to balance, the value of the asset has to go down about 15%. Likewise, if the required return declines by about 1%, then the value of the asset has to rise by about 15% for things to balance. Right now, the math has been hurting investors. The trouble with central banks, they are responding to the inflation by taking money out of the system, by trying to get it under control. Ultimately, this is slowing the economy. They're saying slow down. So what we will see is individuals and companies have less money in their pockets to spend. And I suspect that central banks, until inflation is under control, will continue to slow the economy. Will that get us into a big recession? Will there be an earnings slowdown? How long will this last? These are all questions that's, it's uncertain because the economy is so complex, but certainly we're probably going to go through some sort of slowdown. Some of this is already going to be priced in. Now, what do you do in this environment? Well, our focus has been on focusing on the process, continue to build resilient portfolios, both on the bond side and the equity side. I want to tell you about a stock right now. The stock is called JDE Peet's, a boring stock that's in the coffee business. I'm going to say it one more time because it's so boring, you might not have caught it. JDE Peet's, which has about 10% market share in the coffee business. There's a picture of a cup of Illy coffee. They don't own that brand, but they have partnered with them to distribute little coffee capsules that go into Nespressos. They own Peet's Coffee, they own Stumptown, they own regional brands in Southeast Asia, like Supergroup and Old Town. This is a business that is going to be resilient. People are going to buy coffee. There's a competitive advantage through their brands. They're going to earn money no matter what the environment is. It's just a matter of time. You're effectively, imagine the Monopoly board. You're going around the board, passing go, collecting $200. And at the essence, whether you're invested in bonds or invest in equities, it's that sort of wealth creation that over time creates the compounding algorithm. Process-wise, just to remind people what we do to ensure that those cash flows are actually there, that these businesses are actually resilient. We look at all the historical public documents. We interview competitors, suppliers. We look at our own internal database. M42 has over 8,000 companies in it, over 340,000 notes and pieces of research. So often we know so much about these businesses. In this case, JDE, when it was private yet, bought a public company called Old Town. We used to own that in the global small cap portfolio years and years ago. So this is all information we have in our database. We interview the management team. We build a discounted cash flow model. We build a report, which includes our analysis of the forensic accounting and ESG factors. And we come to a recommendation. All this work is really important to ensure that the company is ultimately wealth creating, reasonably valued at the time of purchase, that management is executing properly, and that it's going to be resilient. So I'm going to leave you with some silver lining. I told you why math can hurt. I'm going to share why math is beautiful. And this is this magic algorithm of compounding. And this is when you take your coupons from bonds, your dividends from your equity investments, the earnings that the companies retain to reinvest. As the math in the market reprices, as that required return goes up, even though that the value of the assets might go down temporarily, you're compounding at a higher rate. And this reinvestment rate is so important. So we're not going to know when the bear market ends. We're not going to know how long it goes on for, or how much more volatility or sort of wild geopolitical events there will be. But ultimately, the mathematical algorithm of compounding takes place, and that's when math is beautiful. So I'll leave it at that and turn it back over to Janelle.
Math is beautiful. Thanks, Paul, for describing a bit about what's been going on this year and sharing some insight into our investment process. Next, I will introduce our other panelists who you may recognize from last year, starting with Crista Caughlin, who's the lead manager of Mawer's Canadian bond and money market strategies. Crista, I'm sure there are a lot of listeners awaiting your thoughts this year. We also have Christian Deckart, our Deputy Chief Investment Officer, who co-manages the Global Equity Fund with Paul, as well as co-manages the Mawer Global Small Cap Equity Fund. Finally, we have Jeff Moe, who co-manages the Mawer New Canada Fund and manages Mawer's US Mid Cap Equity Fund. So let's dive into questions. Christian, Paul just spoke about the importance of process and creating value for clients. Could you talk a bit more about this investment philosophy and whether there's any opportunities that are presenting themselves right now? What's the team excited about, if anything?
Yeah, thanks for that question. In the current environment, I would summarize as bad environments create good opportunities. So what we're trying to do to buy wealth creating companies run by excellent management teams at a discount to intrinsic value, that is a common sense investment philosophy. And of course, the issue we face is that other people have access to that philosophy as well. We didn't invent it. It's something that Berkshire Hathaway has popularized all over the planet for 60 plus years. So opportunities aren't there all the time. We keep looking for them, and the more we look, the more we believe we'll find them. But in an environment like now, where we have down markets, where stocks are becoming cheaper, and where there is volatility and dispersion between single stocks, that's of course an environment that gives us more things to look at, more things to do deep dives on. And maybe the thing that's not obvious from the outside is the timely disconnect between process and proceeds. So in our mind, the ideas we find now, they should benefit us and our clients maybe in 2, 3, 4 years. There's a funny saying, you really make most of your money in a bear market. You just don't realize it at the time. So we work really hard these days to find new ideas, knowing that it's probably going to be years before they pay off, because stocks are a long-term investment.
So Christian, what would you advise investors to consider in an environment where inflation persists? Well,
I have many personal thoughts around that, how to manage inflation in your personal life, but in the context of this, I think it's important to bring that back to something Paul said, I think several times here. What we're doing is we're not predicting the future. Actually, the system we've set up is non-predictive decision making. So you may have heard the simpler phrase, prepare, don't predict. So we don't know how long inflation lasts. We're aware of all the arguments why there might be a a full decade of high inflation, but we're not making a bet on that. In our opinion, the best strategy to prepare and deal with inflation is to do something which is actually embedded in our philosophy. I've mentioned the factor of wealth creating companies, and they can only create wealth for shareholders if they have what we call pricing power. So the ability to increase prices without significant harm to their sales volumes. That's always been part of our philosophy. But I would say it has mattered less for the last 10 years as we didn't have inflation. So it's been a fail-safe that's been in our philosophy for a long period of time, and it may matter now. I just have two numbers on top of my head from two companies owned in the global equity fund. Nestle, which you might know, it's the Pellegrino water and your Kit Kats and ice cream and also coffee. They're actually the largest coffee company, even ahead of JD Peet's, which Paul mentioned. So Nestle, in the last quarter, they reported price increases on average of 7.5%. Another company we own in global equity and in the US equity fund is Procter and Gamble, which you know from many household products. I think they increased prices close to 9%, announced price increases of close to 9%. So you see, if a product is really needed and wanted, then yeah, there is ability for good companies to pass on inflation. I think that's a very reasonable hedge.
So if it hurts you when you go to the store to buy it, it's helping you in your portfolio.
Keep that in mind, at least for Nestle and Procter and Gamble products, if you are a global equity unit holder. Yes, that's the silver lining, Janelle.
So very much intertwined with the inflation topic is interest rates, which Paul discussed in his presentation. There's, of course, been significant hikes this year by central banks around the world and more expected. I think the next one right after this call. Crista, could you first explain what exactly is a neutral interest rate and how does that fit into central bank's policy?
Sure. So the neutral policy rate is the rate that's consistent with an economy whose growth is at potential and inflation is at target. So said another way, it's the interest rate where central banks are neither stimulative or restrictive. Now, it's a number that's not fully observable. It's more of an estimate that central banks have made to help them to guide policy. The Bank of Canada, for example, believes that the neutral rate in Canada is somewhere between 2% and 3%. And so if they're above that, they're thought of they are in restrictive territory and they're trying to slow demand, which will slow inflation. And if they're below that, they're trying to stimulate demand and stimulate inflation.
Okay, so do you think that the expected rate hikes will be enough to hit peak inflation in the next year, or is there more work to be done by central banks? I know we're trying to predict here a little bit. Yeah,
I mean, I think, central banks have done a lot globally over the last year. And I think whether or not they've done enough, I think is likely going to be more region dependent. In a place like Canada, I think they have done quite a bit. The Bank of Canada rate today is 3.75. They have indicated they're going to do more. They'll probably get to 4, maybe 4.25. But if you think about that in the context of that long run neutral rate, which is 2 to 3, they're very much in restrictive territory, particularly given the debt levels that are in Canada. We know Canada has, we all know Canada has one of the highest household sector debt levels, private sector debt levels, and that means interest rates are going to have a larger impact on the economy. In addition to debt levels, one of the things we've been spending time understanding is really the structure of the debt or the term structure of the debt as well. In Canada, it used to be common to get a 5-year fixed mortgage. I think over the last 5 to 10 years, that's actually changed. People are getting shorter term mortgages. So instead of a 5-year, you're getting a 4-year, potentially a 3 or a 2-year. And that means you're refinancing your debt faster. And so you're exposed to higher interest rates at a quicker rate. Even post-COVID, I think we know post-COVID, over 50%, almost 60% of the mortgages were variable rate mortgages. And so they are actually exposed right away to these higher interest rates. And so not only the level of debt, but the term structure of debt is substantially shorter in Canada than in other places, which means that policy will have an impact faster. And it's not dire, it just means you're refinancing at these higher rates. And so more of your income will go towards paying your mortgage versus being able to spend on other things. And so we do think Canada's done quite a bit here. We're starting to see it in the data as well. We've seen housing soften. We've seen consumer goods slowing, particularly volumes, retail volumes. We've seen employment softening. We've actually had employment losses in the last few months in Canada. And finally, actual inflation numbers. The majority of it is headline. We've seen commodity prices come down, but we are actually seeing core prices soften as well. And so all to say, if you kind of put that all together, we do believe Canada has done quite a bit. We'll see if it's enough, but at this stage, we do believe they've done enough to bring inflation down. How
about the U.S.?
It's a little bit, it's a little trickier in the U.S. The U.S., they have less debt to start with. They deleveraged quite a bit through the post-financial crisis. In addition, they actually have a longer term structure. Mortgages in the U.S. are, it's not uncommon to have a 30-year term on your mortgage. So it would take you, in theory, 30 years before you have to reset at these higher levels. And so it's not clear that in the U.S. they've done enough. I think they may have just hiked quite a bit today, or they're going to hike again today. Could be 75. And I think it's more likely in the U.S. that they're going to have to do more than it is in Canada, in my view.
So then on the other end of it is the recession question and the ongoing debate about whether we experience a shallow or a deep recession. Are we already in one? What indicators are you watching on this front, Crista?
I think it's gonna all come down to that inflation backdrop. To be honest, we do believe we're going to see a material slowdown in growth in Canada. That's probably consistent with a mild recession. I think if you're at zero growth rate, I'm not sure if that's too different than a modestly negative growth rate. But that view is really predicated on the idea that inflation does come back towards target over the course of the year. And so by next year, their inflation in Canada is considerably closer to target. And what that does is it allows central banks to, one, stop the hiking cycle. So they are, stop pushing rates higher, but it also gives them the ability to respond if growth starts slowing more materially. If inflation stays sticky between here and sort of over the course of the year, or if inflation actually starts moving higher, that means central banks will either not be able to stop the hiking cycle, they'll have to continue to push rates higher. And I think that's going to be the catalyst for a much deeper recession.
Okay, one last question for you, Crista. It's on asset mix. This one's about the decision whether we intend to add the U.S. mid-cap equity fund to our balanced funds. Do you have any thoughts on that?
Sure. Yeah. I mean, I think with any new fund, the asset mix committee will evaluate whether or not there's diversification benefits, as well as return benefits to adding that fund into the balanced portfolio. I think with the U.S. mid-cap, we do believe there are enough differences between that fund and the rest of the investments within the balanced portfolio. So it does have the diversification, it does have return enhancing characteristics. And so it will get added to the balanced portfolio at some point. I think at this stage, or the hesitancy, I guess, with respect to it has really come down to timing. And that's comes back to the macro backdrop. We're in a pretty uncertain macro environment right now. And traditionally, when you're in a more uncertain environment, there's greater downside pressure on small caps, mid caps. And so we've been a little bit more cautious in the balanced fund. I will say there is a very large cash balance within the very large cash levels within the balanced portfolio. And so as we become more, as we get more confident in the direction of the macro backdrop, as we gain more confidence in the direction of inflation, we're going to look to deploy that cash. And I think US mid cap would be a place that we would deploy it.
Thanks, Crista. Back to Paul. Jeff, I promise we'll get to you at some point. We've been asked if Mawer would consider a dividend-focused fund or any other type of stable income equity fund that would be considered an alternative to bonds.
The direction that we would probably go, this is kind of a Crista question too, actually, but we would push further out into credit. We have some credit in our existing fixed income portfolio, but there's the potential to do something that's more standalone and more yield enhancing. And there's probably as the market has repriced because of the math, more opportunities that have popped up that are frankly very attractive and in some cases competing with different levels of equity returns. So that's probably the direction that we would go. We'll see, timing dependent, but directionally, that's where we would head.
Okay, and any other new funds besides kind of yield-focused funds? And if so, when might they launch?
The other one we're, aside from the US Mid, which is the newest launch fund, one of the things that we're working on is private equity. This is a sandboxed fund, so there's live money in it, and we are running it to start to build the track record as we do with many funds and get it going. That's something where we have to figure out how we would market it. So far, it's off to a wonderful start, building a diverse portfolio, really extending our investment philosophy just into the private equity world. And you could see that being offered within a balanced fund perhaps, or a global equity fund as a sliver, or perhaps on a standalone basis. And so timing wise, it's probably not going to be this year, but probably next year, we'll take a real hard look at whether we can make a more significant launch with it.
Thanks, Paul. Okay, switching gears, Jeff. This one's around US political rhetoric, and it's seemingly worsening. How do you air gap that risk in your investment strategy? Is the question.
It's definitely a risk we're monitoring, although as my colleagues have already said, it's not a risk we're trying to predict, rather just prepare for. It's a particularly tricky risk to monitor and prepare for, actually, because it's not one that obviously shows up in your discounted cash flow scenario analysis. You can't just model in charged political rhetoric the same way you can model in rising labor costs, for example. The way we think about it, though, is on a company-by-company basis on a portfolio basis. So on a company-by-company basis, we look to invest in businesses that are not too tied or not too expected to be tied to heavy regulations. The second way we look at it is on a portfolio business. For businesses that are highly regulated, so we identify that risk when we do our risk screens, and we note that we are taking on this risk. Obviously, we are asking for a commensurate return potential for taking on that risk on a company-by-company basis. But when we look at a portfolio level, whether we're looking at the US mid-cap portfolio or US equity portfolio or global smaller global equity portfolios, although the two global portfolios obviously would have a lot less US exposure, we try to limit the aggregate exposure to heavily regulated industries. And we also try to diversify the type of regulations that the businesses face. So again, it's very unfortunate to see the direction that the US political environment is heading, but that is how we think about that risk.
Thanks, Jeff. And another one for you is around Mawer's current view on the energy sector, given its strong performance this year. Have your thoughts on oil and gas investments changed at all?
So Mower has always viewed energy as an investable sector. I would say notwithstanding its perhaps recent loss of luster given the rise of ESG considerations in investing. So if you look at across our platform, our two Canadian funds, a Canadian Equity Fund and the Mawer New Canada Fund, has consistently found worthwhile investments in energy. For our non-Canadian funds, however, they have occasionally invested in energy, but I would say often have found companies that perhaps are better opportunities in other sectors. And the reason for that comes back to our investment philosophy, which is that we look for wealth-creating companies, i.e. companies that have a competitive advantage. And energy, oil and gas especially, by definition, is an industry that produces a commodity, oil or gas. And so it's just harder to establish competitive advantages in more commoditized sectors. That being said, I think we have found some companies across the entire platform that we think make sense. And in this current valuation environment, there is certainly some uncertainty around where oil and gas prices ultimately will go. There's been some windfall profits. And in some cases, valuations have not fully reflected the reality. And you actually would have seen a couple of initiations across the Mawer funds in oil and gas companies in the 2022 time period.
Thanks, Jeff. On that topic, Christian, what's Mawer's exposure in Europe as we head into winter in the face of energy insecurity?
Yeah, in the global funds, Europe is an important part, especially if you think of developed markets. Europe is a large part of that. And indeed, the situation, as you said, in Europe is difficult or did look very difficult a few months ago, especially on the energy side. But as my Canadian colleague Vijay always says, the best cure for high prices are high prices, especially in commodities. So last week, natural gas in Europe traded at negative rates. So you got money if you took gas out of the system. This is just the very front end of the curve, the 1 hour. But the 1 month is back to where it was before the Ukraine invasion. Why? This is simply to do with, as we see in Ukraine and Russia, logistics and matter a lot. And the oil and gas logistics in Europe was just that most of the gas was bought from Russia. And gas, for instance, that we produce here in Canada or North America goes through LNG elsewhere. And some of these flows have to be redirected. So Russian oil and gas seems to go more towards Asia because Europeans don't want to take it anymore. And it took a while until Europe had established new supply chains. But yeah, as it is for now, on the 1 month forward, natural gas trades us at the same price as it did before the invasion. I think that's a powerful mental model where I quoted Vijay before with a high cure for high prices are high prices. And it goes back to what Jeff said a little bit about commodities. They are commodities. They are exchangeable.
Okay, so given there could be headwinds in Europe going into winter, it sort of segues into this next question that's specific to the global equity funds, higher returns over the past 4 years as compared to our international equity fund, which has no North American equity exposure. Is investing in the United States the better option compared to the UK and Europe looking forward?
So the beginning of your question clearly implied that that's true. It was the better option. Unfortunately, we don't know the future. So I think part of the gap in the last few years has simply come from US large cap tech. If you look at the weight, and I'm not talking about our portfolios now, I'm just talking benchmark to give people an idea of how markets are structured these days. In the global index, the MSCI ARCWI, Apple right now, only Apple is a weight of roughly 4.5%. So of all sort of, well, the whole investable universe. And I think there was a point last year where the whole energy industry had a weight of less than 3%. So Apple right now worth 1.5 times what the whole energy sector, the whole world, all these companies together were worth about a year and a half ago. So I think it's been a lot driven by US large cap tech, the US outperformance. Will that continue? Difficult to say. I think our advantage on the global equity fund is twofold. The first one is, well, we have the largest opportunity set. Imagine you're buying a car and you go to a car dealer that has 2 cars. Are you going to get a really great deal there? Well, if you go to a car dealer that has hundreds of cars, you have more choice. That's the pleasure or the beauty of working on global equity for Paul, myself, and our colleague Mawer. We can pick from the largest opportunity set. That looking at deal by deal, car by car, company by company, has led us to a roughly 50-50 split recently between the US and non-US investments. On a company by company basis, we're comfortable with that, but I think it's difficult to make any macro predictions. The only prediction I would make is Europe seems to be very much out of favor, and I think the experience of investors is that usually the higher returns will be in the things that are out of favor, and the lower returns will be in the things that are in favor.
Thanks, Christian. Paul, could you share your thoughts on investing in China right now amidst the tensions with Taiwan and Biden's increasing involvement? Have we made any adjustments to these exposures within our funds?
Yeah, it depends on the fund. So where we have most exposure overall is the emerging market fund. And that would have been, at one point, close to 50%. That's actually down to closer to 40%. And so that's just a risk that we've been actively monitoring. I was just talking to our portfolio manager, Peter Lampert, last night on the issue. He's actually out in the Middle East interviewing companies and looking at assets out there. And, we're continuing to search out other ideas. Just to paint the perspective, in global equity, we really haven't had that same sort of exposure. And partly, Christian, what would our look-through exposure be at this point? I mean, it's practically, it's tending towards.
Well, the look-through, Paul, right, by company headquarters is zero. But if we look at where our companies make revenues, I think it's in the 5 to 10% range. Because if I may add that thought, if you look at Nestle that I've mentioned before, or Procter & Gamble, yes, they're a Swiss and an American company with Swiss and American governance and so on, but they do have operations in China.
Exactly.
So we do have some economic exposure, but not headquarter governance exposure.
Same with BMW. So if painting the picture of global equity, we still have exposure. It's not as direct. It's smaller and manageable. And I think it's one of these really, Janelle, and for the audience to understand, unknowns. Like, who knows what's going to happen with American policy with respect to China, with Xi's leadership, with relations with Taiwan. The best strategy in the face of this sort of uncertainty is you diversify, you keep little bits of exposure, you try to find ways to arbitrage out risk, which, Christian and I do a lot of on the global equity side. But it's about balance, moderation. I'm not sure how that's going to play out. Maybe nothing happens. Maybe we're in a different world regime.
So kind of further to that conversation, there's a question about the semiconductor sanctions and whether these are exaggerated or a real issue for global supply chains.
That's a good question. Jeff, you might have some perspective on this as well, but certainly there's already been a trend towards onshoring for security, and technology is actually, in some cases, I would say, almost being weaponized just like perhaps people consider the oil market being weaponized, technologies considered, you might consider that to be weaponized too. So, we've known for a long period of time that countries around the world were investing in fabrication facilities on the ground to build out capacity for this. So that's kind of a continuation of that trend. Jeff, what are you seeing with some of your companies, just comparing and contrasting the US mid experience?
Sure. So we actually own KLA Corporation in US Mid, which is a semiconductor wafer fabrication equipment company. And I would say that this is a story that's been playing out for several years now, as China and the US go from, call it co-opetition to just straight competition. And so semiconductors and high technology is the tip of the spear for the decoupling of the two supply chains between China and, call it the West, the Western democracies. And so when you look at a company like KLA, they're based in California, but they sell globally, including to China. We've seen their stock be on a downtrend for almost a year now, partially due to the concerns around their potential to continue to make money selling to China. And we all saw the news about a few weeks ago that the Biden administration is limiting the export of higher tech and more advanced semiconductor manufacturing technologies to China, which will hit KLA as well as some of the other US peers. But while the stock was weak the first couple of days that this news came out, over the subsequent days, the stock actually rallied because this as news kind of came out and people figured out the exact exposure, it was less than what people thought. KLA and their competitors, ASML, Lam Research, could still sell to China. And so we actually saw the semiconductor sector rally as it became more clear. So certainly this is on people's minds. We all know about the US CHIPS Act and how that's providing US government stimulus to essentially onshore and build fabrication plants in the US. TSMC, the world's most advanced chip manufacturer, is building a fabrication plant in Arizona. So this is happening. This is certainly a risk that we're keeping an eye on. In my mind, it's probably harder for China than it is for the US, because the US just has to spend capital to rebuild stuff they already have effectively, whereas China needs to spend capital to figure out technologies they don't yet have, which is certainly tougher.
Thanks, Paul and Jeff. We've talked a lot about managing risks and how we think about risks. And as a follow-up question, how do we stay disciplined in our approach, in our investment approach, and keep FOMO, or fear of missing out, in check? Paul, do you want to take this one? Yeah,
so you can think of 4 elements to the risk management process. And that's the short answer in terms of FOMO. It's all about process, slowing down, thinking about things consistently. And what we do across our investment team, we're almost more like a factory. That's how much we think about process. But think of 4 buckets. The very first layer of managing risk is actually culture at the firm. Do we get along? Are we able to communicate to each other and share ideas and information? If we ever get to a point where there's a sender or receiver problem where we can't get information to a person to make an investment decision, that's actually a huge risk. So that's our starting point in terms of how we think about risk. And actually, culturally, in our research team, we have a system where we check in every 60 days with our people so that we know of any challenges that are coming up in their career, what's going on in their life, how their work is progressing, to make sure that things are going well and to manage sender receiver problems. Next level up is following our investment philosophy and process. So on the equity side, Christian mentioned buying wealth creating companies, discount to our intrinsic value, management teams that just manage the business very well. So we have a process around that for looking at all the companies. And I think people are aware about this, but we rebuild each and every company. The work what we do around a stock, we rebuild that on an annual basis. And the reason we do that is to make sure that we're on track, we're managing that risk. The next level up to think about risk is just simple diversification. We have parameters in every portfolio to avoid making behavioral error. So as an example, it doesn't matter how excited we get about one particular stock, we have a maximum self-imposed limit of 6%. And so that's there so that, you know, you can't get too excited about something. So there's minimum diversification constraints. And then finally, the last part of the process is about making the companies resilient. We have a weekly risk management meeting to pick out themes and trends in the world. We have a check-in process in terms of risk management and an interview process so that portfolio managers are aware of these themes and risks in the portfolio. And this is not only about diversification, but to make sure that in whatever scenario plays out, the portfolio is going to be able to bounce back from a scenario that isn't optimal. So that's how we think about it, Janelle. It's all about process.
Thanks, Paul. Two questions have come in about risk, specifically around Russia. So the Emerging Markets Fund had some exposure to Russia at the beginning of the year. What happened to that exposure, and how is it likely to affect the fund in the future? I don't know if Christian or Paul, you want to take that one?
I'll take a stab at it. This was, I wouldn't even characterize this as risk. This was pure uncertainty, where you had a situation where the invasion led to a collapse or boycott of a particular country's securities. It's a very unique position. We were selling securities into that event. We didn't know the odds. This was a very difficult thing to know on an odds basis. Afterwards, the securities were the remaining securities that we had were basically written down. So there's not very much value in them, and it's basically negligible in the emerging market fund. What does this mean going forward? Could there be value recovered from that? Maybe on depending on how events unfold. There is always the risk of, some sort of geopolitical risk. That's just an added challenge with emerging markets. And there's also the flip side of it. There's very attractive securities that you can get lots of growth and they can do well, and they're being handicapped as an emerging market stock. And that's, the other side of the risk return spectrum. Christian, I'm not sure if there's anything that you want to add on this question.
Well, I have a zoom out comment, maybe a bit, and relating to the Global Equity Fund. Our emerging market weight peaked probably in 2016, 17, 18, Paul. And then as we look company by company at what deals can we get around the world, our emerging market weight just declined because we felt, the quality valuation relationship wasn't favorable. So we are at a very, very negligible low single digit weight right now. Given how negative the sentiment is around emerging markets these days, I wouldn't be surprised if our emerging market weight in global equity kept creeping up again. As I've said before, I think often the best returns come from buying cloudy scenarios, or as people used to say, when there's blood on the streets or when the cannons sound or something like that. And when you buy blue sky scenarios and a happy future, then often, all that bright future is discounted into the price and put into the price, and the potential for disappointment is higher. So I would just say, we're aware that emerging market on the risk spectrum are just further out, and and when they offer an attractive or over attractive return compared to the risk, we're very open to go there with a global equity fund.
Thank you both. Crista, this next question is about the correlation between stocks and bonds and whether that inverse relationship will hold again. Can clients expect bonds to be that ballast in their balanced portfolio that it has been in the past?
Yeah, so when I think about why they're correlated and sort of when it breaks down, it really breaks down when you're in an inflation environment while growth is slowing. I think very top down. So I'm, central banks are targeting an inflation. And if inflation is elevated, it really reduces their ability to respond to a slower growth environment. And so if you have risk assets responding to weaker growth backdrop, but you have central banks responding to raising rates because they're responding to a higher inflation backdrop, you kind of see the correlation between those two break down, which I think is exactly kind of what we've seen this year. Is it here to stay? I think I don't think it's here to stay indefinitely. How long will it last? I think that will really come down to where we are in the inflation cycle. We've already talked about a shallow recession versus a deep recession. There are deflation scenarios still out there. So there's a lot of scenarios that exist aside from just this elevated inflation forever scenario. And so it's not clear to me that this correlation is going to be broken down indefinitely. We've actually seen pockets this year. There were times where we saw that reestablish itself. I would say it does impact your portfolio positioning. It obviously impacts portfolio sort of balancing if your correlations are changing. And I think it's important. Something that we always do is we evaluate investments on a standalone basis as well as in the context of the portfolio. And I think the balanced fund is a good example of that this year. We have one of the highest cash weights we've had, I think, in decades. And that's really a function of not just sort of betting on historical correlations, really evaluating all of the underlying investments on a standalone basis, understanding the various scenarios, and then a positioning accordingly. I think one of the questions was it going to be, will it be a ballast or will it create stability in your portfolios going forward? And I think, bonds have been down this year, but they have still had less volatility than some other strategies out there. So the correlation is broken down, but there is still a diversification benefit. And so it did actually reduce the volatility of your returns. And I think that will hold going forward.
Good point. Thanks, Crista. The next question is a stock-specific question for Jeff about a company called Dye & Durham, which is a Canadian software company that we hold in the New Canada Fund. Mawer has been quoted in the media to comment on our position in this company, and the question is really if you could elaborate on, in the context of this company, how we assess management teams and the process for providing feedback to management teams as well if we have concerns.
Yeah, absolutely. So Dye & Durham is the leading provider of software and data for lawyers that handle real estate and corporate transactions. And so management has been aggressively expanding through acquisitions, even before its IPO, but since they IPO'd in July of 2020 with the use of external equity capital as well, been expanding very aggressively, both in Canada as well as to other English-speaking common law countries like the UK and Australia. And so there are a few things that we evaluate. So with management, we have a management assessment framework where we have 7 points that we go through and assess. Some of the key ones, especially for Dye & Durham, would be execution on their business strategy, how prudent we think the business strategy is, as well as how strong the capital allocation is, especially in Dye & Durham's case, being an aggressive growth by acquisition company. And so for several of these points, we did feel that over the last 2 years, our view on management has shown us that they are a very risk-seeking group. And so that has caused us to appropriately adjust our rankings and ratings on the management team. A few examples of aggression is how large the acquisitions they pursue in comparison to their own company is, requiring them to digest a very large acquisition and all the integration risks that go through it. For example, very recently, they tried to buy a company in Australia called Link Group, which actually had more revenue than Dye & Durham itself had. So that obviously would create a very large transformation and change for the company. As well, they've been very aggressive in hiking the prices to their customers. Now, in and of itself, we don't necessarily think price hikes are bad, as my colleague Christian was talking about. Sometimes that can be very good for the companies we own. However, in this case, Dye & Durham hiked the prices so much that it became headline material for the Globe and Mail. And when we looked at the prices, their justification was they had added additional features to the product and therefore it justified a higher price. And to some extent, we agree with Dye & Durham's view. But we also remind the management teams that the management team at Dye & Durham that there needs to be a social license to how you manage some of the price increases that they were trying to push through. And so overall, I would say we still believe in the company and the collection of assets they have. They still are the dominant player for this type of data and software they provide in Canada, in the UK, and increasingly also in Australia. However, that's offset somewhat by our view that this is a very aggressive management team. And while aggressive management teams, if things work out well, can lead to potentially great returns, there is also a higher level of risk that comes with that. And so today, I would say the position is more right-sized to what we view is the appropriate balance between that risk and reward. Whereas, call it 12 or 18 months ago, it was a much larger position in the Mawer New Canada Fund.
Thank you, Jeff. I think we have time for one more quick question before our hour is up. And there's a couple of notes on just short-term relative performance of the funds. I wonder if, Christian, you could take this one specific to the Global Small Cap Fund, just recognizing, we're long-term investors and just maybe explaining a bit of the gap in the shorter to medium term.
Yeah. That sometimes is the case in investing. Long-term and short-term performances fall apart. So the case of Global Small Cap is a curious one because in 2021, which was a year of underperformance, the fund absolute was still up by 5%. So that fell into that period of FOMO that I think you mentioned before, Janelle, where in the small cap universe, one asset class that's further out on the risk spectrum and where we had to deal with meme stocks in the benchmark and so on. Be boring didn't make money in that environment. So 2021 positive in an absolute base, but not relative. And then 2022, that's the real surprise, in my opinion. We are in Canadian dollars. We're negative. The benchmark is negative, but we are worse than the benchmark. So it's absolute losses and it's relative underperformance. And that is not what we would normally expect from a be boring, make money portfolio. I think what has hurt us, among other things, is certainly the underweight US and overweight Europe. That's a situation we've had for a long period of time, and it worked. It worked partly in our favor. That didn't hurt us as much, but this year, it has hit us. So, as you said, long term still good, but short term looks, especially 2022, does look painful.
And can you share just a kind of an outlook looking forward? You know, why we may not be skating to where the puck was, but looking ahead at where it could be going forward and how we're
we were
positioned.
overweight. We're overweight Europe and the non-US parts. The US isn't closely engaged in the war in Ukraine. Also, our Japanese positions, while would have been in a normal scenario, we would have expected them to add stability. The Japanese yen has depreciated significantly this year. So that was the stability we had expected from our Japanese holdings. Didn't pan out that way. And then if you want to talk about specific things where maybe we made some investments we wouldn't make today. The funny thing is, I don't think we make these all the time, right? We make these in a bull market like we make them in a bear market. So I don't think there's a difference. There's a difference there. The regions were certainly one of the big drivers.
Okay, thanks, Christian. We're just over time now. So thank you to everyone who submitted such great questions. And I know there were more that went unanswered. So if you have questions you would like to follow up on, please feel free to reach out to your Mawer advisor or email your question to the events@mawer.com email address for additional information. Thanks so much for joining us today. This will be recorded and the link will be sent out that it lives on our website. And if you're in Calgary today, stay warm and avoid the roads. Thanks again.